I'm Charlotte McLeod with investingnews.com, and here today with me is Gareth Soloway, Chief Market Strategist at verifiedinvesting.com. Thank you so much for being here. Great to have you as always.
Oh, thank you, Charlotte. Always great to be here and discuss the markets.
Really good to be catching up, and it has been a few months since our last conversation. Of course, quite a bit has happened. And as usual, I want to begin with gold. You had told us in that previous conversation that 2,500 was going to be a lock for gold in 2024, and we have gotten to 2,500. So I think it is fair now to ask what's next for gold. Do we need to see some consolidation now at this level?
Yeah, and that's quite the move on gold, to be fair. Like, it's really been a strong move up. I do think that we're a little bit overbought in the near term, but I still think gold has more upside to go. So let's just jump into the chart and take a look. And what we can see here is that gold right now is right into that $2,500 level. And so what that means to me, and there's a couple things here. So there's different time frames that a trader can trade or an investor can look at. You can either have the shorter term or the longer term. Now, the longer term, there's still further upside on gold. My next target is $2,660. I'll show you in just a minute how I arrive at that target price. But I just want to show you guys this. This is something that is a little bit concerning to me. This is called the RSI, and this is a shorter term signal telling us that gold may pull back in the near term. And what we have here is the RSI tells us relative strength. It's the relative strength index. And the only thing you care about on this is the divergences. Now, in terms of price, look at price. Price has gone up and made it the high and a higher high. But if we look at the RSI is downsloping if you connect the highs, and that is a lower high on the RSI. That's called a negative divergence. So what that tells me is we likely will pull back in the near term, but then use that as a buying opportunity. And just to give you guys a sense of what I'm kind of looking for, I would look for this trend line right here, a pullback to about 2,400, and then at that point start buying again for that next bigger move up. And I think ultimately, I think we all agree, everyone watching this probably agrees that the Fed is going to go back to easy money policy. They'll probably expand their balance sheet. Central banks continue to buy, which is a bullish indicator for gold. And the U.S. government and really governments around the world continue to use debt as their main way of financing, which for precious metals is a long-term recipe for success. Now, lastly, I'll just throw this up. I'll show you guys how I get my target. I flipped over to the logarithmic charts, which allow me to go back to a long time ago and use trend lines. I go back to my 1979 high right here. We're going to connect it to our 2011 high. And when we do that, a trend line comes into focus here, where if we look at that trend line, it's right around that 2660 level. So I think, again, whether or not it's by the end of this year hitting that, or if we can hit it just, in the new year, I'm not sure. But I do think this is pretty much the next leg up for gold that'll take us about $130, $140 higher from here.
Okay, I think you covered a number of elements that I wanted to go into. So I was looking for buying levels for gold. Looks like that is 2,400, because I know it gets quite difficult for people to figure that out as the metal keeps going up and up. And 2660, the next target, which we may get, I think you said, maybe this year, could be early next year. What are you seeing beyond that if we take a very long-term perspective on gold? Because you did mention how looking longer term, it is looking bullish still.
Yeah, and that's always the trickier. So one thing to always remember for us as investors is that when we look at shorter time frames, our analysis is more accurate because there's not as many variables. Once we go into years out, it can be very, very tricky. So I can definitely speculate on that, and we can look at the chart again. But just always be aware that the longer we look out, the harder it is to predict. But, for me, things like this, right? If we flip back to our regular chart from our logarithmic chart, we can look and say, and this is kind of an interesting one, right? So this is something I was playing around with. So if we look at the bull run that took place on gold from 1976 to 1979, that 1979 high, it was about a 750% bull run. If we look at the low in 01 to the high in 2011, it was about 630%. So it seems like it's slowly moving lower by about 120%, in terms of the upside. But that still puts us at about a 500% rally off of the lows from 2015. Now, this is kind of if we had our, for those of you out there like me that have holdings in longer term in gold, this is like the magic, like everyone wants to hear this. And if we do that, and we go up 500%. I have to keep dragging my chart down here to kind of get that into play, but we still have to keep going here. So we're almost there at this point, guys. But really what we're looking at is, let's say we do 500%, you're looking at around a 6,000 price target. And again, just to understand, that would be 750 was the first bull run, 120% less is the next one, and that's easily measured. So if we do 130% or 120% less on this next bull run, it takes us to about 6,400, 6,300 on gold. So that would be kind of the wish list. I think we all would love to see that. My only caveat to that would be this, is that if gold goes there, I do worry about what the macro economy and the global economy looks like. I mean, that is, all of us that are gold bugs, we buy gold for protection, but also we have to recognize that if the instability hits where gold goes up that much, how much other risks are there to us in society, essentially. So I would just throw that out there to keep that in mind.
I think that's very important to remember, and thank you for hearing me on that request. We won't hold you to that particular target because, as you said, as it gets longer term, that's when it gets harder to predict, but really interesting to look through. So thank you for going into it. The other thing I want to ask, so I know that you're really focused on charts, technical perspective, removing emotions from the market, but I know you are active on Twitter. You have your own community of people that you're in contact with. How is sentiment feeling in the gold space right now? Are we seeing that interest now come in from people who weren't interested before?
So I think it is starting to, right? So there was a period over the last 5 years where a lot of younger generations were like, gold is for old people. Let's focus on Bitcoin. But I do think as gold has now made new all-time highs, it's started to come into focus for younger generations that kind of wrote it off and saying, hey, listen, this is a more stable asset that can still go up in value, but ultimately it's not as volatile as a cryptocurrency like Bitcoin that can go up or down 20, 30% in a day or a week. And so I think it is starting to catch on. But I think one of the bull drivers is that the average investor is still unbelievably underweight gold in their portfolios. And that, again, if that weight just comes back to the average historically that gold was in people's portfolios, you do see a significant further upside on gold because of that. So I think it's at the very early stages, which definitely tells me that, for me, my 1 to 2 year outlook is north of 3,000 very easily. And then obviously that 6,000 and change target would be kind of a 5-year plus target price out there.
I've got one more question on gold before I let us go over to the Fed and other larger factors. So really good to go into what's happening with the gold price, but I know a lot of investors are interested in gold stocks. They want to have that leverage on gold. And we've talked in the past about GDX. I think that's the main thing you're looking at when it comes to gold stocks. And comparing year to date, I think they're about even when we look at GDX versus the actual physical gold price, maybe a little bit more for GDX. So do you see that changing at some point?
Yeah, so I do think that as gold goes up more and more, it starts to influence the gold miners more and more, meaning that they should outperform more and more. And I think the key is this, is that everyone has a profit margin. And with inflation over the last 5 years, that's why GDX and gold miners underperformed, because gold wasn't going up, yet inflation was skyrocketing. And so they were paying their miners, their equipment costs were going up. All of these costs were going up. Now, gold is starting to move up, which is compensating them for that additional cost. But the more gold goes up, when you can get $3,000 an ounce for what you could only get $2,500 prior, that almost is pure profit for the miners. And so ultimately, if gold really does go on a bigger bull run north of 3,000 and inflation stays, let's say, at 3% or so, it really does put a good spin on the positivity on GDX. And I just want to show this chart. This is a classic wedge pattern. And you can see wedge patterns, by the way, just to define it for the audience, is you have a low and a big move up to a high. And then from that point, it's tinier and tinier, lower, each low is a little higher, each high is a little lower, and it creates this kind of essentially a triangle pattern. Now, this is kind of what we call, it's a winding spring. So it's tightening, tightening, tightening. And then once it breaks out, it really goes pretty parabolic. And we can see that Once that broke out, it really had this beautiful up move where we've gained about 35% on GDX in the near term. Now, if gold does pull back in the near term, I think GDX gets pulled back as well. But that can be a positive for us as investors because we can find these levels to actually have entry opportunities on GDX. So, for instance, if GDX noticed pivot low, pivot low, pivot low, this tells me that if price hits here, this would be a place to start a position long on GDX at around $34.50, we'll call it. If it continues down, you always have a chance that it would retrace into these two lines down here, which could be an additional accumulation zone. But I think the key is, as long as we hold that longer term perspective on gold, that the economy, that the debt levels, that the Federal Reserve banks will continue to kind of print money for every situation of hardship, then you do want to just continue to move into gold miners. But as I always say, folks, stay diversified. So a little gold, a little silver, a little miners, because again, you just never know which is going to be the big winner. Like you said, gold has actually performed equally as well as the miners up to this date.
Okay, good to take a look at that as well. And as we've been saying, if we're talking about gold, we have to take a look at what the Fed is doing. So we had Powell speak at the end of last week. It now sounds like, I guess we've been thinking that a rate cut is definitely coming in September for a while, but now it seems very, very secure. And maybe the better question is it going to be 25 basis points or 50? So curious to get your thoughts on what you see coming in September from the Fed, and maybe any thoughts on Powell's comments last week.
Yeah, so the biggest thing that stood out to me was that Powell was really dovish, talking maybe even if there's a weak jobs number, we might get a 50 basis point cut in September. Even the Fed minutes that came out earlier that week, I was a little surprised that many Fed officials had fought for a rate cut in July. And most people rejoice at that. Oh, yay, the Fed's ready to cut. That's great for asset prices. They're going to zoom higher. I took a different stance on that. I said, wait a minute, the Fed seems very nervous here. What do they know about the economy that's going wrong that the rest of Wall Street is ignoring, right? That investors are ignoring. Now, number one, that's probably pretty good for gold because it's a safety asset. But overall, for a stock market that had fallen sharply about 3-4 weeks ago and is now rebounding to almost all-time highs, that's a big concern for me. And I think we have to just be aware that you have to read between the lines. It's good the Fed might cut, but if the Fed has to cut too much, it's because something has drastically gone wrong in the economy. And I'll just show my chart here on the 10-year yield so we can take a quick look. But the 10-year yield to me, number one, it broke down, right? So there was another wedge pattern here and you had a breakdown and it's continued lower. I actually have the 10-year yield going to this longer term trend line here all the way down around 3.25%. So I do think there's more downside in the 10-year yield, which means things probably are not great in the U.S. economy, maybe global economy. We know China's still suffering quite a bit in their economy as well. But in the very least, I do think there's more downside. And the Fed, it probably means the economy is not doing well. Otherwise, the Fed would not be cutting as drastically as that.
Yeah, I was going to ask, do you have any inklings of what it could be that the Fed is possibly seeing that is a concern there?
Yeah, so I think they've brought up a little bit like on the jobs data. The jobs data is starting to weaken. We saw the unemployment number jump pretty sharply last report. And in fact, we're due for a week from Friday. We'll get the next number out, the August jobs report out. So that's something that's going to be watched very closely. Jobless claims, unemployment filings have been relatively muted, but I do think that they're seeing some things on the job side that is concerning. And they also brought up some other concerns in the financial industry. For instance, leverage being taken in the bond market. So, when you make money cheap or give banks loopholes, they tend to exploit it and sometimes not very responsibly. And I think there's some other things that they're seeing probably in the commercial real estate side as well that is very big of a concern. And what I mean by that is there's a lot of banks out there in the U.S. specifically, but probably in many countries that are holding on to commercial real estate. And we see here in the U.S., some of these strip malls, 50% vacancy rates. And right now, this is what we call zombie banks, where they're holding on to these massive losses, but because they don't have to mark to market, they don't have to realize these losses. And that's kind of keeping them floating. But if you see a downturn in the economy and a big downturn in the stock market, eventually investors are going to get frightened by this and run, and then you have another financial crisis.
Right. And I think another, or kind of on the same note, something that we got out of Powell's comments is the Fed is shifting away from the inflation concern to the jobs market concern. And one thing that I often hear is the Fed often moves too late. So are we in a scenario where, again, they have shifted their focus too late?
Yeah, and to be honest, I'm not sure on that. But what I do know is that you're right. Historically, the Fed is late to the punch, which is why if you look at past periods of Fed cutting, it's usually when the stock market actually starts to drop is when the Fed starts cutting. And it's not because of their cutting, it's because of why they're cutting. And the market's starting to say, wait, they're cutting. Oh my goodness, they're late. They should have cut already. They should have cut more. And the market gets panicked about the economy. So I think that's an issue. I also think the bigger thing that I'm concerned about is, inflation's down to about 3%. It's not at their 2% level. If they have to cut dramatically, does it then kickstart the next cycle of inflation that then comes in? And ultimately, if inflation starts upticking and the Fed needs to cut, well, do they cut with the potential of really having inflation spike like in the 1970s? Or do they step back and say, hey, listen, we can't cut because inflation's too high. So the economy just has to deal with the slowness or the recession on their own. And these are things that when inflation is north of 2%, this is a concern that we're going to have to deal with over the next 6 to 12 months.
Okay, yeah, definitely a lot of points to keep an eye on there. And I think you said so usually the Fed doesn't cut until we're already seeing problems in the stock market. So right now it looks like we're going to get a cut ahead of that. So what happens to the stock market as we start to get these cuts?
Yeah, so I do expect downside. The S&P 500 is holding up relatively well. I do want to show this chart. I think this is an amazing chart on the S&P 500. Let me flip to that chart now. But if we take a look at this, this is actually the S&P 500. Let me bear with me as I just look at this. I want to bring this all the way back here. We're going to go all the way back to 2007. And I want to show you guys the craziness of what we potentially are repeating here. All right, so here's the 2007 top in the market. And this is your current top. Look at the similarities, like freakishly similar. So currently we had this bull run up, 6% drop, and a low put in. We then had our latest bull run that lasted from May of this year all the way up to our all-time high. We then had a 10% drop with a higher low, and we shot up. Well, let's go back to 2007. 6% drop, low, big bull rally, 11% drop, almost so 6%, 11%, and we've had 6% and 10%, almost identical. A higher low, and then we shot up. And look at what we've done here. We've shot up. Now, if this follows 2007, we all know what happened in 08, 09. But what we can see is that the market, the S&P actually did make a new all-time high, which basically takes the bulls and empowers them, but it also stops out the bears. The bears freak out. Oh my goodness, a new all-time high. They throw in the towel. So it almost makes me think that we could have one more move up, make a new all-time high on the S&P, but then we know if we zoom out here and look at what happened following that new all-time high, and look at the collapse that we saw all the way into early 09. And so I would just caution people here, right? Markets are near all-time highs, but it doesn't mean that we're not in the process of a bigger top. And there's a lot of issues out there, whether it's China, whether it's the U.S., whether it's the consumer slowing down, the debt issues of the country or the world, or wars. There's just a lot of risks out there for a very, very expensive S&P 500 at this point.
Okay, really interesting to see those side by side. It is a little eerie, as you said. And to our last conversation, so you had mentioned how Bitcoin had become intertwined with the stock market. So a stock market decline would be bad news for Bitcoin. So are you still now seeing that same relationship and that same expectation?
Yeah, so I am to a fair degree, and I think we have to just be aware that we've seen periods here in Bitcoin where it is following the stock market, but then at other times it kind of diverges a little bit. But if we look at the chart here, what we can see is that in general, Bitcoin's been going sideways to lower, while the S&P obviously has made a new all-time high about a month ago, and then and almost back to the all-time high. So there is a little divergence. But one thing to note is this drop here, this low was on August 5th. This was the same day that the NASDAQ was down over almost 6% pre-market, and the S&P was down, I think, about 4%. So there is this coordination here as well. And I still am very concerned that if Bitcoin breaks this zone, this trend line here and this area right here, that we then are put in a position where we could see a much bigger decline on Bitcoin if the S&P falls. And just to give you guys an idea on a potential target, we could be looking at something as low as around 30,000 if it were to fall down there. Now, again, it may not get there. Maybe the stock market doesn't have a big correction. But if we do see, like, let's say a 20-25% drop in the stock market, it would be very easy to think that we could get down to that level. I mean, just think about this, right? If we look at the drop from here, which was 70,000 to 50,000, right, or 49,000, if we just take that and we drop it down from this low, essentially that measured move of just this dip to this dip would take us from this low at getting back to there down to about that 30,000 level. So again, for me, I'm a huge long-term bull on Bitcoin, but I'm also a realist, right? I'm not one of these hodlers that just puts their head in the sand and is only bullish always. I'm aware of the interconnection of asset prices. I'm aware of psychology, the human psychology syndromes, which is, fear is pervasive. If you get fear in the stock market, people get scared and they sell assets and they exit and put it in cash, right? And so I think we just have to be very aware that there is a tie here with Bitcoin and the stock market. And if the stock market does pull a 2008, 2009, Bitcoin likely gets crushed.
Okay, good to have that context as well on Bitcoin. And you've mentioned recession, I think, a few times in this conversation. And just to officially check in on your recession stance, I know you were looking for one heading into the end of 2024 when we spoke earlier this year. So it also seems like others in the market, other experts aren't sure if we're getting one. So updated thoughts on recession in the US.
Yeah, so for me, I still don't buy this soft landing, no landing scenario that the Fed is spinning, that a lot of mainstream media is spinning. Again, there's too many issues out there that are now coming to the forefront. We're seeing consumers slowing down their spending habits, and remember, we aren't even in a recession yet, and we're already seeing that slowdown. And so for me, whether it's at the very end of this year or next year, I do still see a recession coming. And it just, a lot of it is just connecting the dots. It's very rare the Fed has ever been able to kind of choreograph a soft landing or no landing scenario. The odds are definitely towards a harder landing, mainly because the Fed tends to be late, right? They were late to start hiking rates, and in general, they're late to start cutting rates. And also the inflation side of things makes it harder for them to cut rates, which puts us at more risk of a recession. So I'm still in the camp that we will see a recession. The timing is the tricky part, either end of this year or next year.
It seems to be getting further down the line, but it does sound like it's still coming. So we'll keep an eye on that recession question.
And just to interject on that, I think one of the reasons why the recession has been pushed off too is that as long as the stock market has been going up, the consumer a lot, and I shouldn't say the consumer, it's a specific portion of consumers that have investments like 401ks. Those people are just looking. I mean, we were going up nonstop almost all the entire year. So those investors are saying, wow, I feel richer. I am richer. Look at my 401k. I can still spend money. And that's kept this recession at bay for the time being. But if the stock market does top and we start to see declines, those investors will start pulling back from spending. And that's where the recession will come very quickly.
That makes a lot of sense. So thank you for adding that. I want to make sure that we get over to silver as well. So silver, we had a little bit of excitement between our last conversation and this one. We did see silver get over $30 per ounce. We are not above 30 at the moment. And I know a lot of people are waiting to see if it will catch up with gold, as it usually historically does. But curious to see what you see in the charts for silver, if that looks realistic in 2024.
Yeah, sure. So silver right now, we are seeing a down day. It's had a nice move up. Same kind of deal. If you look at the low on silver here, this was right when the stock market bottomed out as well. The stock market's getting a little iffy now as we're going into these NVIDIA earnings and then the PCI data later this week. So we are seeing silver pulling back. So I'm definitely not quite as bullish in the short term on silver because there's that industrial side where silver is affected by the economy, how good the economy is. If we look at other charts out there, I mean, I think you have to pay attention to something like a nickel. I mean, nickel has just plummeted. It's come off its lows, but I mean, this is a massive decline in nickel, and you can look and see some of these other declines in these commodities as well. And so the industrial side seems to be really suffering, almost telling us that there is going to be a recession. In fact, that's one of my base cases, is that if you look at a lot of these industrial metals, they've been crushed, and that is telling us something. Like even copper. I mean, taking a look at copper. Now, copper doesn't have the rarity, neither does nickel of silver, but still there's a huge portion of investors, or at least in the industrial side, that's what silver is used for. So again, same thing with copper. Copper, we've had a rally because the stock market's rallied. That narrative of a soft or no landing has come back in. But with silver, that's my biggest concern. It's that if the economy does weaken, silver's going to have a lot more trouble rallying versus the safety and kind of the safe haven asset that gold is. So for me, if silver were to come back into this level, take a look at this level. This is a great level here. There's a long-term trend line here. And then we also have this parallel channel. So these two lines will meet somewhere around $24. I know people don't want to hear it potentially goes to 24, but look at it like a great buying opportunity. Since I do think longer term silver does go a lot higher, I would look to buy at these key levels pretty aggressively.
Okay, yeah, I think you're right. Nobody wants to hear 24 for silver when we've had 30 this year, but buying opportunity. Okay, so I always love to ask you about gold and silver, precious metals, but I'm curious, you have a much broader array of elements that you're looking at. So any other charts that are particularly interesting to you right now that you're keeping an eye on?
Yeah, I mean, I think the palladium charts, the platinum charts are definitely interesting. And I think for me, it's the scarcity. I'm a big believer in scarcity as a value factor. And so, if we just flip up, let's say, take a look at platinum. Platinum really hasn't done a lot here recently. There's this big wedge pattern that's been created, but you also haven't seen the move up that you've seen in gold. And I think it's important for those of us out there to understand that platinum is actually much more rare than gold. Now, granted, it doesn't have the same demand from people around the world. You're not buying as much platinum jewelry and so on and so forth. But in terms of rarity, it's actually much rarer than gold. And therefore, on weakness, if you're looking to diversify away from potential, inflation or printing of money and just massive debt, this would give you an alternative place to go with gold where you diversify into these type of metals. And same thing for palladium. Palladium, I don't think is quite as rare as platinum, although people will correct me if I'm wrong on that. But ultimately, you can see it. This has been beaten down like crazy. And at some point, if we get a breakout above this 1020 area here, it's 1020, there's a lot of upside on these. So these are definitely ones that are on my radar for potential significant appreciation over the coming years.
Okay, good to get your thoughts there too. You're not the only one who has told me you're keeping an eye on platinum and palladium. So I think people should probably take note of that. This was really good. I think we can wrap it up there unless you had any final thoughts or words of advice you would leave people with as we head into, I guess Q4, the end of the year.
Yeah, so I think just be nimble, people. If you're watching this, remember the market sometimes has periods where we just grind up and making money is easy on the long side, but there will be periods where things are not so easy. And I do believe we're entering in one of these periods that the market is going to be much more of a trader's market in terms of the stock market versus the market we've had up to this point. And I think, again, you find the metals that you like and you diversify little bits, buy dollar cost average type stuff. That is always the best policy versus going all in on one buy, because none of us know how low these things could go or how high they can go. And so you just want to kind of take it one step at a time.
Okay, very good. Thank you so much for coming on to talk, and hopefully we have you back again soon.
I would look forward to that. Thank you, Charlotte.
Of course, and once again, I'm Charlotte McLeod with investingnews.com, and this is Gareth Soloway with verifiedinvesting.com. Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.